Well, if you're 26 to 34 and you've done tech for the last 6, 8, 10 years, all you've known is growth. You've only known the age of quantitative easing. And you've been told, go get market share, grow at all costs. Now, in some environments like Houston, it's like be a little bit more efficient than that, but it's grow, grow, grow. All of a sudden, the rug is pulled from under you and you're told, be efficient, manage growth with profitability, and you're a company that has a $250,000, $500,000, million burn rate. What do you do?
Welcome to Forging the Future. And it's no secret that the Houston startup ecosystem is on the rise. And so I'm excited today to be sitting down with one of the leaders of venture capital in Houston, Blair Garrou. Blair is the managing director of Mercury Fund. And Blair, it's great to have you on the show.
Thanks, Chris. Thanks for having me.
Yeah. So tell me a little bit about how you actually got to Houston.
Yeah, it's a circuitous route, so to speak. So I guess a bunch of people know I grew up in Boston. And the tech world was really kind of introduced to me through my dad. So he worked for Dow Chemical out of Boston, but he focused on substrates that manage and handle semiconductors. So I grew up with my dad talking about chips, being in the semi business, and this was kind of like 80s, moving into the mid 90s. Moved to Charlotte, North Carolina for high school, and my dad took a business development job, and so he was flying back and forth to Japan and South Korea. And whenever we would come home, he's like, you have no idea what's getting ready to happen. So he was talking about, the computing space and the software space and all these things that were going to be enabled through chips and Moore's Law. And I was kind of like, okay, Dad, no problem. I was playing sports, reading comic books, doing my thing. And so after high school, I went to college at a small liberal arts school in Virginia, Washington and Lee. My dad wanted me to go into mechanical engineering, and I ended up, being a liberal arts major, and he's like, oh my God, what are you doing? You're going to miss it. You're going to miss it. I'm like, miss what? What are you talking about? So I went up to W&L and met my wife, Amy Carrington. She was from Houston, and she was a couple years younger than me. We kept dating after college. I went to Deloitte. I was actually an accountant. I don't talk about that because a lot of times accountants aren't looked upon as being creative, and so it's not my VC thing. But I worked for Deloitte in DC, and all of our clients were tech companies, right? This was the early 90s, hardware companies, software companies, telecommunications companies. And so I started seeing what my dad was talking about. Now, my wife, who was dating at the time, she applied to veterinary school. And she got into 4 schools, and Texas A&M was one of them. But she also got into schools up on the East Coast because I thought we'd move to Boston, move to San Francisco, I get my MBA. And her dad calls me, and he's like, son, I think you're pretty serious about my daughter. And I said, yes, Mr. Carrington. And I called him Mr. C, kind of like, Bonzi.
Happy days.
Happy days,
Yeah.
Exactly. And I said, well, yeah, what are you thinking? He goes, well, I can tell you this. If she goes to Texas A&M, I can guarantee you, if you marry her, you will not have a negative dowry. And I kind of laughed, didn't really know what he meant. And I did the math, and I literally quit my job in 2 weeks and moved to Texas.
Nice.
So true story. And that was 1997.
Well, it seems that wives and husbands are one of the popular reasons for getting here to Houston. I'm still in Houston because I married a Houston girl. So, I married the girl next door. Actually, she was across the street, but, the girl next door.
Exactly. There's so many of us, I think, are pulled here, by our spouses. And a lot of people I know in the entrepreneurship space, their spouses are either in the life sciences or healthcare, aerospace, or the energy, kind of the energy field. So, Dr. Amy pulled me down.
You started out in accounting. You saw the internet boom. You were working at Deloitte. And how did you get into venture?
So when I got here, I took a job in investment banking. I was told by a lot of people, hey, if you can get an investment banking job, looks great on your resume. You kind of have to reinvent yourself from your accounting background. And it was kind of a difficult leap to get into tech or venture. I kind of knew I wanted to do something, but I had no idea it was venture capital. I thought it may be like entrepreneurship, something different. So I did investment banking in the energy space, but this was 96, 97, 98. I learned a lot, but oil hit $10 a barrel. So my firm was pitching ideas that just weren't going to work. And so I had some time on my hands. And so I ended up volunteering at this startup effort, which was a nonprofit incubator that a lot of heads of state in Houston were trying to put together to help these internet startups that were starting to form in Houston. They were forming everywhere, right? And this place was called the Houston Technology Center. And so I would go over there a couple days a week, almost like after school, and I'd help people with their financial models, their business plans. Being in investment banking, you get really good at financial models and PowerPoint. And that's what a lot of these entrepreneurs needed.
You were volunteering there?
Volunteering.
I love that. A lot of people need to give.
I know. And I was looking to get out, right? I don't know if I was thinking about it as giving versus finding another pivot in my career, but really waited for an opportunity to jump in. And at first I was a development manager for the Houston Technology Center and then kind of director of operations. But I left a really good paying job in a career that I think people could identify with. And everyone understood Houston was energy. But when I took that job, my friends who were all living everywhere, my parents, even people here were like, son, what are you doing? Tech in Houston? Like venture capital in Houston, working with startups? That just is absolutely insane.
Well, that was interesting because I think by the time I knew about Houston Technology Center, I was wondering why it was called Technology Center, because by that time it seemed that it had turned into real estate and energy or something. I don't know what was going on, but I didn't see any tech there.
Yeah.
So it's curious to me to hear that it was actually formed in the beginning to kind of support these internet startups. During the Compaq days, I guess.
Exactly.
Right?
So Rod Canyon, the founder of Compaq, he was one of our mentors. And so I would bring him in from time to time, sit back and just listen to how he evaluated startups. One of the startups at the time was blinds.com. So Jay Steinfeld. So I remember Jay coming in and he needed help, he needed assistance, and he wasn't necessarily getting it from me. There wasn't anything I necessarily knew that I could help Jay on, but what he needed were doors open in the community. And so at that early stage, I saw that, networking and understanding, how to get Jay in front of various groups to be customers, tax credits, whatever that might be. The Houston Technology Center as that incubator was basically opening up all those opportunities for him.
Interesting.
Yeah.
So it was the HTC was the OG of SDOs, I guess. Right?
It was. And back then, it was mostly internet startups, a handful of life science startups, and some things in energy. But, innovation energy, it's different. It doesn't necessarily form that way. But I remember my second week there, so I worked for a guy named Paul Frazon, who was a life sciences executive. But our chair was Lloyd Benson III, so the son of Senator Benson. And he called me into his office and he said, Blair, sit down. And he handed me a sheet of paper, right? He actually wrote on a piece of paper. And I look at this piece of paper and there's 50 names and phone numbers on it. And I said, well sir, what's this? And he's like, what do you know about angel investing? And I said, I don't know anything. And he's like, well, I need you to look it up. I need you to fly to the East Coast and fly to the West Coast, go attend some angel meetings. And what we're going to do is we're going to put an angel investment network together. And he explained what angel investing was. And what he had given me was a list of the 50th wealthy people in Houston, all friends of his. And he wanted me to call them and form an angel organization. So the next 2 days, all I did was pick up the phone and have people hang up on me. I was leaving messages on voicemail, waiting for it to call back. But eventually, I got 25 of the 50 to come to a meeting, and they brought some friends. And that first meeting was when the Houston Angel Network formed. And so businesses would come to Houston Technology Center. We would get mentors for them. We would help them write their business plans, put presentations together. And then once a month, we would take 2 or 3 and we would bring them to this angel organization and hopefully get them funded. And for the next 9 to 12 months, we probably got anywhere from 20 to 30 companies funded in Houston. And it was such a learning experience. Again, Chris, I'm still learning. I'm not giving much of myself. I'm just kind of organizing and making things look good. But sitting there and listening to everyone, like I was learning through osmosis.
That is wild. I didn't actually know the origin of Han, which ended up at one point being one of the largest angel networks in the country,
Right.
I actually joined Han this year.
This year?
Along with Goose Capital, which also was formed by Rod Canyon.
Yeah.
So, which I think just underscores just the importance of getting this flywheel going in Houston, where you have entrepreneurs create businesses, have success, have an exit, and then hang around and actually support the community and start these other organizations that can actually support additional founders and startups. And so Rod was doing that a long time ago, right? And it's pretty active, and there's these organizations that exist today. But I think that in Houston, there's still like the flywheel is spinning very fast, it seemed like, right? You know, so there wasn't a lot available here other than what maybe Rod was doing. There weren't so many SDOs. So now things have sped up in the last 5 years. But how do we get more of those kind of founders to stick around, stay in Houston, and do like what Rod was doing? Right?
Yeah, you got to get people to give back. I mean, his fingerprints were everywhere. Things may have been started by others, but the minute you had Rod Canyon show up, kind of like now when you get, Doug Irwin, comes in, or Keith Crew, or people that kind of came after Rod. Really, really important, kind of from what I saw early on, that you really needed those people to kind of, get some leverage through.
Because what was happening, and still happens to some extent, is that they get traction here in Houston and then end up in other places, whether that's Austin or West Coast or something like that. But then we are starting to see like companies like Cart, which came out of, the same founders, similar founders from Blinds.com that you mentioned.
Yep.
But now they've started Cart.com, and then they moved to Austin, they moved back. And we had Remington on the show a few episodes ago. But we need more of that, right?
Yeah, we really do. What's interesting about Cart and Blinds, out of that entire wave of angel network companies that got funded, Blinds.com was really one of like the only companies that HTC had helped that really had enduring success from a software perspective. So, Omer Tarek got his start there as a financial analyst. Eventually, Home Depot came in and bought them. Omer continued his rise, continued to stay in Houston, give back in Houston. So when it was time for him to like do his first deal with Cart, it was like, the future kind of folding back to the past. It was like really, really interesting to watch.
Right. And we need more of that, right?
Exactly. More of it. So
I think it's starting to happen, but
I think so. I think when Cart exits, I think you'll see the effect like when Blinds exited, right? I mean, Jay taught probably a dozen people who then went on to be entrepreneurs or like the key number 2 or number 3 in some of these companies. And I think you'll see the same thing with Cart as you will a number of other companies like High Radius, Sashi's company. So I think the best is yet to come for Houston.
So you started with Han and you helped build Houston Angel Network, which was something I learned today. That's great. And how did you then get into venture? And you were fairly young when you started in venture.
I was. So the chairman of the Angel Group was a guy by the name of Paul Hobby. And Paul and some of his contemporaries were probably mid-40s at the time. They saw the same thing other people saw, which was there was this technology and innovation boom. So they went out to form a fund called Genesis Park. Now, Genesis Park still exists today. It's a private equity firm. But back then, they were looking to do startup investing. So they hired me out of the Houston Technology Center to be an associate and essentially bird dog deals. And there were a few of us that went to work for them, and we learned venture. And we not only learned venture from them, who are all really good business builders, but we went out and met with groups like Seven Rosen and Austin Ventures. We took trips to the coast. And that's when we started going out and finding mentors of some of the early VCs, like some of those partners at Austin Ventures. So I was at Genesis Park for 5 years. And one of the things they did there was when we would make an investment, they would ask me, okay, Blair, you're not going to sit on the board because you're too young, but what's the company really need? I'm like, oh my gosh, they need marketing. They need a CFO. They need this. They need that. They would actually throw me into these companies and these operating roles, which just wasn't done back then. Now you see that a whole lot more. So for those 5 years, I did about a half dozen companies that I put the thesis together for, but then I would actually jump in and out. And that's where I got a lot of my operating skills. And it was a lot of fun. But at the end, the Genesis Park team really wanted to build a private equity firm. And so I had to figure out what was next. And so I ended up becoming CEO of one of our companies called Intermat. It was a company founded by a guy named Jeff Beecham, who to this day is one of my mentors. And we ended up running that company, scaling it, and then selling it to IHS. And so at IHS, I had the opportunity to stay there when the company was going public. Or a good friend of mine, Dan Watkins, he was kind of a contemporary in that while I was doing Houston Technology Center, he had co-founded the Rice Alliance. And then he had put a small fund together where he was doing university tech transfer. And he had built a relationship with a group called Draper Fisher Jurvetson. So Tim Draper, Bitcoin fame now, he was looking to form a fund in Texas, and he had built a network of funds, called the DFJ network. They didn't have a fund in Texas. Dan, who's just really gifted in the sciences, was early doing nanotech and med device. And they said, hey, we think we want to kind of franchise our fund model around this guy. And so he called me when I was at Intermat and then sold to IHS and said, hey, do you want to join? I said, absolutely. And so at the time, my wife had our first baby. So rather than going with a public company and fly around the world, I took what I thought was work-life balance to launch a venture fund. Little did I know how much time I'd be putting into that over time.
Interesting. So then what did that become then? That was a DFJ fund? Or?
Yeah, it was a DFJ fund. So DFJ Mercury.
Okay.
And at the time, Austin Ventures had publicly announced out of Austin that venture was dead.
I remember that.
Remember that?
Mm-hmm.
And it was in the papers. I think it was the New York Times. And they said, hey, we're moving towards the puck. And the puck is saying private equity. And so they started forming a private equity group. So there was a huge gap in seed stage capital for software companies, science companies, you name it. So the first DFJ Mercury fund, Dan led science investments and I led software investments. So we did that for 2 fund cycles pretty successfully. But in my software investments, the first deal I ever did was Alert Logic. And that happened to be one of the first SaaS deals for infrastructure. And at the time, the coasts were saying, no, SaaS is only going to be front office, like Salesforce, things that are applications, not infrastructure. So we're kind of going against the grain. But what we saw with SaaS companies was 80% of a SaaS company can be built exactly the same. The product methodology, the go-to-market, like the engineering teams. And I wanted to keep on doing software. We saw software as a real strength of Texas and other places. And so we ended up spinning Mercury out of DFJ Mercury, made it all software, and then kind of went down this road. But having an all software fund to me was really important. I'm more of a believer in specialization, kind of than being a generalist fund. And so myself, and at the time, Aziz Gilani, who was an associate, he came over and was partner. And we added a third partner, Adrian Fortino, and opened up an office in the Midwest in Detroit, places like Madison, Wisconsin, and Detroit, Ann Arbor, Michigan, Urbana-Champaign, at U of I. And what we found in doing that were there were a lot of ecosystems, much like Houston, just waiting to be unleashed. A lot of entrepreneurs, a lot of innovation. And so at that time, we came up with a strategy of saying, hey, we're not going to make DFJ Mercury just Texas-based. We're going to make it for Middle America. And so it took a long time, but we went from city to city, building relationships, helping to build these ecosystems and finding these really interesting deals. And so ultimately, when I spun Mercury out, we kept that strategy because we thought that we could be one of the go-to software firms in the middle of the country for entrepreneurs. And it's a model that's hard to replicate because you got to take a lot of time and meet a lot of people and build those networks out. But it's amazing even to this day, the deal flow just pours in. 90% of our deals is inbound, where most firms have to have an outbound strategy of kind of dialing or emailing, for deals. And that's worked really well for us over time.
Interesting. And you just raised your 5th fund?
Just raised our 5th fund, closed it a couple of months ago, so $160 million.
That's great.
The timing is great because, as you know, the markets have shifted.
Kudos to you.
In a big way. So having dry powder in this environment is good. And I mean, the entrepreneurs need it. We're not just happy because it's great timing. There's so many good deals in need of capital out there. I just flew in from a trip I took to North Carolina and South Carolina. I was in Durham for a day and Greenville, South Carolina for a day. Amazing entrepreneurship cultures in both of those cities. What was really blown away by Greenville, there's like an entire group of West Coast entrepreneurs and tech executives that have moved there for quality of life post-COVID, and they're all starting amazing businesses. And so, the whole COVID, emergence of tech, post, the pandemic, it's really put middle America on the map and in ways that we never even expected.
I suppose now also because of the technology, you don't actually have to move your startup to Silicon Valley, although I think Silicon Valley would disagree with that. But
I think you're right.
I just feel like, even in my own businesses, just the, ability to have people wherever you can find them and the talent that you need wherever you can find them worldwide,
right?
Is just so powerful. And not have now with, like you said, people have relocated. They have the experience, they have the know-how. They don't want to live there. They want to live somewhere else, like you said, quality of life. But they're still great entrepreneurs, right? Or,
exactly.
Potential founders.
And I think young people, they've figured out the hybrid thing, right? I mean, developers, they've been working in hybrid environments for years, and now I think a lot of people say, "Hey, I can do my best work via Zoom." Culture isn't demanding everyone be in the room at the same time. And so because of that, people are working where they want to work and they're finding talent wherever they can find it. And that's been a huge plus for Houston. I mean, I don't think it's any coincidence that our ecosystem has grown not only by leaps and bounds, but by quality at the same time that hybrid work has been something that is acceptable, I would think, by venture capitalists and by the acquirers of the companies as well.
Yeah, that has required a little bit of a shift too, right? So the investors have to be a little more comfortable with, having a distributed team. And there was a mindset that wasn't really possible. You need to have them all sweating in a room, and they need to be all full-time employees, and they all have to quit their other jobs and whatever. But being able to leverage what, is available in the world, just like any of the larger established companies are. I mean, when I started Softtech, that's what I did. I was a guy in a room in an office, and if I needed a mechanical engineer, here's one in Portland. Oh, I need a contract manufacturer to build this. It's in Korea. Here's my battery guy. He's in Seattle. And so it's not like everybody was here or had to be here in Houston, but. At the time, if you didn't have brick and mortar and if you didn't have those employees, you weren't like a real business. And then, I was concerned with some of my larger companies like Compaq and Disney and others, I'm just, a guy in an office leveraging people in Belarus and other places in order to get the job done. Right. But it wasn't like traditionally thought of like as a stable business.
Exactly.
Right? But I think, taking advantage of the technology of what it gives us now. I mean, there was no Zoom back then either, right? I mean, so and now you can be there. Right?
Yeah.
I find myself standing in my home office just like I did 25 years ago. It's just, I've got 400 employees now, and back then it was just me and then whoever else I could find. But the business model works. That's how I grew my business. Right? And I think that, when it comes to talent, you can find it. And it doesn't have to be in your own backyard.
No, exactly. The hybrid work was such an unlock, for I think all of us. But the other piece we found was typically growth capital. Once you got your company to 3, 5, 10 million, you really need to look outside of Texas or the middle of the country to go find funds. And they would have to get on a plane and come see you. And COVID, they started Zooming. Right? Just like we're doing for work or building a business. And we started meeting all these funds that we hadn't met before. And I think one thing that helped us was we had gotten to scale. And so these groups were like, well, wow, if you're in the deal, we're comfortable. Right? We still want to meet the entrepreneur eventually, but we can do all of our diligence, get to a term sheet. So we saw probably 2 to 3 times our companies get these later stage rounds, but also raise a lot more money than they ever could. And I think before it was much, much harder to go out and grab market share because you couldn't raise the money. You could raise 5 or 10, but you couldn't raise 50 or raise 100 or do what Cart did and go raise 250, right? And go kind of attack a market. So that's just been wild to watch, take place.
It can be done faster. It can be done easier. You don't have to get on those planes and, trains and automobiles in order to get in front of every single person.
Yeah.
So when you raised your latest fund, is that mainly coming from Texas investors or probably mid-market investors or where, if to the extent you can share?
So about 60% is institutional money, and most of that is through endowments and foundations. And the endowments and foundations, they're all in our region. It's really interesting. We haven't had success raising on the West Coast or the East Coast, but we've had lots of success raising from the large universities, both private and public, in which we operate. I think venture historically has been taught that it's done on the coasts. Again, innovation is not a coastal pursuit, but if you are an institutional investor, if you're a CIO, you want to go where there's the highest probability for success. And historically, that's been the Valley, Boston, and now kind of New York, LA, and a few other places. But I think other cities are bucking that trend. Obviously, Denver, Boulder, then you had Chicago, now you have Austin, Atlanta, and all these other places. But this last fund was the easiest for us to raise. I mean, it still took 18 months. It still took a while. But more and more institutions are seeing that, hey, if you can put money to work in the middle of the country, the entrepreneurs a lot of times are more coachable. They're more capital efficient. And especially in this era that we're in now, you can build some really good businesses with some great returns. And the rest of our funds were made up of family offices and high net worth individuals. We've always had a lot of entrepreneurs and kind of wealthy individuals we've built relationships with, especially here in Houston, who have supported us over the last 20 years.
And did you have to educate those institutions about that kind of opportunity in the middle market? Or?
We did. And so a few of them came in after we had known them probably 5, 6, 7 years. But also, like in venture, the higher your Roman numeral is, the risk has come off a bit. And so a lot of groups won't do first or second time funds. They'll wait till a fund 3 or a fund 4 comes along. So fund 4, which was our second Mercury fund, that was really when we had a lot of the institutions come in. And once they did, kind of success begets success, things do get easier. Now, we still have to go out and prove ourselves. Like the minute we have a fund that doesn't perform, I don't see those institutions re-upping. I hope they do. And they say, well, hey, this fund didn't work, but these others did. But like we've got to prove ourselves kind of every day of the week, just like our entrepreneurs do.
It reminds me, I should have, one of the tricks, not tricks, but one of the things that I did in the past, like I remember my first software product that I released it as version 3.0.
Perfect.
I should have said I was raising fund 3. I mean, why did I go with
the
one?
institutions would have piled in, man. It'd have been so much easier.
Come in, or maybe fund 5 or something. Like I could have done that.
Well, one of the things when we launched Mercury out of DFJ, we thought to ourselves, well, it's a new team, new fund, new strategy. Should we start back on fund 1? But we had some investors come over and said, no, don't do that, because you'll have to wait 2 fund cycles to get institutions on.
Yeah, I did notice that. So Mercury Fund 1 was Fund 3, but because it was, DFJ before that, right?
Exactly.
Yeah, so it
exactly
makes sense. It was a little more legitimate than me calling it Fund 3. So what is the VC role as it relates to startups?
It's interesting. I've been trying to learn this for 20 years. What I thought when I was in my early 30s and launched the first fund with Dan, it's a little different than now. Money's a commodity. A lot of entrepreneurs may not think so, but if you have a good idea, if you have a good deal, you'll eventually find capital. What's not a commodity is the advice, the acts of service, whatever you can do to help that entrepreneur. Earlier in my career, I thought I'd known a lot about building businesses and could help these startups. I'm learning every single day. And so the good experiences, the bad experiences, being able to give startups a framework, not telling them what to do, but saying, hey, let me introduce you to a few entrepreneurs who've done this right. And let me show you some pitfalls for ones who didn't. And hopefully you can kind of find your way. And so I think part of that is just giving that experience to them and giving them frameworks for success. The other piece too, though, is just being a sounding board. Probably like you guys, right? With your, accelerator studio. I mean, I'm texting or on the phone or emailing or meeting probably with 8 to 10 of our entrepreneurs every single day. And, some it's just a constant text stream. I mean, I'm on Slack with 6 of them. Some of them like to text. Some of them want to talk to me like when my kids go to bed, that type of a thing. And you just need to be a sounding board. And, so the job is, part advisor, part therapist. Then there's the governance role, where it's not about the entrepreneur. It's about you represent on the board all the shareholders. And so you've got to wear that hat. And I think, the job is, it's such a blessing to do what we do, but I love it because it's lifelong learning. Like I'm just intellectually curious to a fault, and I'm constantly finding ways to get better. And entrepreneurs are teaching me every day too, right? We get to hear these pitches. It's great. I'm constantly thinking, all right, let's do this, let's move it here, let's move it there. But it's really, almost being like a Sherpa. in some ways and a guide.
Well, I think a lot of startups, I think the ones that succeed and the founders that succeed, realize that there is constant learning involved and there's a lot that you don't know. And listening to other people that might know is really important. And you run across a lot of, first-time founders coming out of MBA school or et cetera. I think they've got it all figured out. They know what to do, right? And it is more than just the money. I mean, if all it took was to throw some money at a startup, VCs would be a lot richer, right?
Right. Or we wouldn't exist,
Yeah,
right? Just
right.
wealthy families would be putting the money directly in.
Exactly. So let me talk a little bit about how things have changed now with the way that the economy has shifted, venture has shifted. It feels like there's a lot less money out there, or at least the interest in funding, companies that, maybe aren't, like growth at all costs, for example. Talk a little bit about that.
Yeah. We feel really fortunate to get our fund closed when we did, because entrepreneurs, they need the money. They need the capital. The era of free money is over. And what we really feel for them, like the empathy towards entrepreneurs, if you think about if you look at all the successful companies in the tech space, like True Innovation, most of those entrepreneurs start the company sometime between the ages of 26 and 34, right? Well, if you're 26 to 34 and you've done tech for the last 6, 8, 10 years, all you've known is growth. You've only known the age of quantitative easing. And you've been told, go get market share. Grow at all costs. Now, in some environments like Houston, it's like be a little bit more efficient than that, but it's grow, grow, grow. Now, all of a sudden, the rug is pulled from under you and you're told, be efficient, manage growth with profitability, and you're a company that has a $250,000, $500,000, million burn rate. What do? You didn't hire towards that, right? The skill set to do that is much, much different. And so now you've got companies who need money. They haven't really built efficient business models. And a lot of them should probably find another idea and or pivot. And then the rest of them hopefully have cut burn. Over the last 2 years, I would say 70, 80% of our portfolio, we have about 50 active deals, have cut burn anywhere from 10% to 80%. And we've just said, look, you've got to be within being cash flow positive, EBITDA positive, whatever that looks like. And so this new era of efficiency is going to be really difficult for a lot of entrepreneurs who didn't necessarily learn how to build businesses that way. Now, the ones that can figure it out, they're going to reap the rewards because there's so much capital sitting on the sidelines. The money hasn't gone away. Yes, it's harder to raise a venture fund. Yes, institutions are upset because the returns aren't there in venture. But the money that was raised over the last 3 years, I mean, you add that up, it's the 3 greatest years in venture raising ever, 2021 and 22. Now, 23 was abysmal, but there are just, hundreds of billions sitting there, and it's now a flight to quality. And so if you can build a quality company, within a number of spaces that are, red hot right now, and you can show that that company can get profitable on a dime, meaning, I've got a $250,000 burn right now, but watch, I do this, this, and this, I'm profitable. If that's what you need me to be, I can do that. I think that's what growth equity and early stage venture is looking for now.
It is a different environment. And it is a challenge to switch on a time like that when you haven't built a company in order to, you built for growth and now you got to build for profit. But aren't we going to miss out on some companies? And we were talking earlier, I mean, there are businesses that have been built over the last 10 years that couldn't have been built in a mindset of like, you need to be profitable from the get-go. I think you mentioned Uber as an example earlier when we were talking, right? I mean, that wasn't profitable for many, many, many years and it wouldn't have been able to take over the world and do it profitably. Probably, or at least it would have taken twice as long.
Yeah, well, think about OpenAI, like all the money it raised up through 21, right? It wasn't until, they released GPT-3 that everyone saw the future and then the money poured in, but they raised a ton of money. But companies like Airbnb, Uber, like even SpaceX, like how could SpaceX raise as much money as it did without the last 10 years? Like, I think if we hadn't privatized space the way we did, right, with NASA and the government and so forth, and allow entrepreneurs like Elon and Bezos and others to do what they did. If that was starting now, I think those individuals have to put a whole lot more of their wealth into it. versus others on the outside looking in. I think it'd be a lot more difficult. I mean, you're seeing the funding in the space sector overall really dry up. I mean, the best companies are getting capital, but being a startup in that area where it's really capital intensive, like you just can't get those capital intensive deals off the ground. And so, is that going to slow down innovation? Well, maybe, maybe not. Luckily, we have AI here to save us, right? In this age of efficiency, not just from a cash flow perspective or how you build your business, but using AI to just build smarter, faster, better. I mean, it'll be interesting to see what the next 3 to 5 years has in store.
It's going to be exciting. I mean, we do live in the future. And the fact that we're building quantum computers that can do, 1 million years of calculations in 6 seconds or something. And you think about the power behind that, it's just crazy, right? I mean, and what they're going to be able to accomplish, and that J curve is really taking off. All of a sudden you're going to have, you pair that with AI and quantum computing, and it's just a massive, massive amounts of of power.
And it'll be interesting to see where the returns come from, right? Like, the book, The Innovator's Dilemma. Well, there's a VC dilemma too, right? Are you a venture capitalist? That's, to coin your phrase, forging the future, right? Putting money towards quantum computing, putting money towards the next LLM, or have you built a business like we have at Mercury where we kind of have to fund companies that have product market fit and recurring revenue, right? I mean, there has to be a return profile in order to raise the next fund because the institutions are looking for the returns, are looking for the cash to come back. And that we're kind of out of balance right now, I think, as an innovation society. I think, things like Biden's CHIPS Act, other, governmental kind of subsidies, really. The government's kind of going to becoming the innovation venture capitalist of choice to get a lot of these things off the ground, like hydrogen and the move to EV and everything kind of going on in some of these other places. But it'll be interesting to see if VCs are truly successful taking those big bets in this environment. Like, I hope the institutional money is there to back them to do those types of things, because a lot of times in these environments, in these recessionary environments, the money just kind of dries up.
Do you think AI could be a VC?
We're worried about it, right? What AI can't do yet, because it's not sentient per se, is it can't replace the board seat, right? I think it can choose the deals, but I think it's difficult. Now, you could say, well, no, you could have a conversation bot that could take the place of you, Blair, on the phone late at night, right, talking to the entrepreneur, and you could have a bot that goes back and forth, utilizing a bunch of FAQs from all the best VCs. So you could probably talk me into the fact that my job doesn't need to exist and it can be replaced.
The Eliza VC, basically.
I know.
You remember Eliza back in the day? It was like,
totally.
Yeah.
But I think, when you get to things like board governance and ethics and these things that are supposedly important, you have some companies that run amok, culturally, and, profit takes over. But I don't know. It'll be interesting in 20 years where we are. And I think it'll happen a lot sooner than that.
So given that, I mean, what is your advice for startups now in this environment?
Yeah, this advice was given to me a long time ago. It said, ask for money, get advice. Ask for advice, you get money. I think if startups can understand that they're going to have more proof points than activity, even in order to raise angel money, that will guide them in the direction of building businesses with sustainable value. Now, I think some entrepreneurs are going to build the next great innovative platform and they'll spin it out of a university or they'll do something magnificent. But for the rest of us, right, that are focused on software or businesses that are a little bit easier to get your heads around, make sure you're building something of value that can get to revenue quickly. Also, we were in an era where startups would raise safe note or convertible note after convertible note after convertible note. Price the round, right? Entrepreneurs have been taught not to price the round, to push it off and to push it off. Go ahead and price the round and you'll get a lot more interest in it. But I think if people build companies of sustainable value and they see that revenue, then they know they've got early product market fit. And if they go out to people like you and me and they say, hey, I need your advice. I think I'm building something great. Can you give me a little bit more thought here? People like you and I are going to be like, hey, you are building something great. Let's keep meeting. And all of a sudden, you aren't forcing the issue of, I need capital. It's, hey, I'm going to talk to people and build relationships 12 to 18 months out. Now when we're doing investments in companies, we usually know them for 6 months before we cut a check. And I think entrepreneurs before were building and just going out to get money because they needed the fuel, like going and gassing up your tank, right? With a gasoline-driven car. Build a relationship, take that time. And I think people will be in good shape. But we're already seeing the economy's going to get better, maybe, right? We think rates are going to come down. That'll hopefully move people to growth.
2024,
right? Let's go see. And I think the M&A environment's going to improve the second half. That's been all gummed up. And whenever companies are exiting to private equity or to strategics, and people are making money, and they see the money being made, the money starts to flow again. So I'm hopeful in the next 12 to 24 months, especially the pre-seed and seed money, that'll start flowing a little easier. But I think entrepreneurs have got to get real about the fact that they got to show revenue and they got to show a path to profitability.
The spice must flow.
The spice must flow. I'm looking forward to number 2.
Yes. Well, thanks for coming on the show, Blair. That's great advice. Hope the startups are listening and being coachable. I do have some socks for you.
This is excellent.
And
because I'm known for not wearing socks too often.
I know. I see you need a pair.
Some.
But hey,
Awesome.
These are your father would be proud of those. I think
These are great.
Semiconductor socks. So back of your roots. So when you do, when it gets a little colder here in Houston, you do have to put on a pair of socks. There you go.
You're gonna see me in them.
Perfect. Well, thanks for being on the show.
Hey, thanks for having me on, Chris. This has been great.